investors around the world on edge this morning. Europe is the cause of volatility right now. Michael Purves says the European Union was never designed to handle this type of stress, and there is an enormous amount of confusion weighing on investors. Michael is the chief market strategist and head of derivatives research at BGC Financial. He is with us in the newsroom now. Michael, good to see you. Thanks for coming back to the Inside Track. Just how low can stocks go today in the U.S. based on what's going on in Europe?
It's a great question. On August 10th, when we saw a great deal of these macro shocks really developing and the market had been plunging, I said there was actually a floor in the U.S. equities, barring a systemic collapse of something in the European banking sector, or obviously clearly here in the U.S. Banking sector. And so, if you look at the levels of sort of 1120, rough number, that's been a key technical level post Lehman Brothers. And for all the ugliness we're seeing in all the headlines right now, I do think that we have basically a floor in the market. But you have to be extremely mindful of what could happen to a true, not just worries and headlines, but an actual collapse in Europe.
Just to remind everybody where the S&P closed on Friday, 1154. So you're saying you do see a key support level at 1120.
Right.
Okay.
Correct.
1120, 1115. Michael, there's not a lot of room between here and there. We're talking about a little more than 3%. Equity index futures down 2%. If the selling accelerates and we blow through that support level, what happens?
It's a great question. Could we see something, could we go back down to 1010 where we did it, which we hit on July 3rd of a year ago? That's probably, a free fall to that level possibly. And that's where investors need to be.
1,000-point free fall.
1010.
I'm sorry, 100-point free fall. Pardon me. I'm thinking in down terms. 100-point free fall. Nonetheless,
so a significant move down. I would doubt we would stay there for that long had we gotten that, unless there really is systemic collapse. But I think, you have to, for all the ugly headlines, particularly in Europe right now, you have to consider that the powers that be are going to be very focused on avoiding systemic collapse. And particularly the amount of, you do need capital into the European banks. French banks are going to be downgraded, clearly. But nonetheless, it's not, it's not a draconian amount of capital needed to at least shore up a lot of these banks.
But for you, for market sentiment, that recapitalization has to happen, is what I hear you saying.
I think it's inevitable. How and when it comes remains to be determined, but yes, it's inevitable.
In the interim, Michael, what are the key indicators you're looking at to try and anticipate the way markets are responding to developments in Europe?
Well, I think, clearly retail sentiment has been a very helpful contrarian indicator. It's not perfect. I think you also have to really look at the fundamentals, though. Valuation. Right now, the dividend yield on the S&P 500 is higher than the 10-year Treasury, and that's a very key point because, I would argue that equities are being bought out of fear as much as greed. And what I mean by that is what's happening in the U.S. is you're having long-term structural monetary debasement. And so if you're long a fixed income instrument denominated in U.S. dollars, you're really at risk of a very fundamental real loss of value. With the S&P, with equities, you actually have, in a sense, a deflation hedge. You have a yield. And you also have a inflation hedge, or a monetary debasement hedge, through the cash flows that are inherently can grow.
The problem with the argument for valuation is that stocks looked attractively valued when the S&P 500 was at 1350. Okay, they look that much more attractive with the S&P 500 at 1150.
But also, if they're all trading together and investors are not distinguishing, right, between company quality and company quality.
What happened in late 2008, early 2009? Stocks surely, on the basis of future earnings, looked attractive then too. At what point do you just have to give up on valuations and try to simply call a bottom?
That's where the rubber meets the road. This is art and science. But my view is that you also have to look at the valuations relative to fixed income. And one thing that's very important in this environment we're in right now is that we should be getting major multiple contraction in a market that zips around sideways, as volatile, as prone to all sorts of ugly macro issues. And yet, that's in a low-growth environment. That's a recipe for multiple contraction. And I don't think one thing that Bernanke has engineered is actually something to help prevent multiple contraction, because he's forcing you into equities because of what's happening both from a yield perspective in fixed income and also from a monetary debasement, really results of his quantitative easing policies that he's been putting into place.
Michael, great to get your thoughts this morning.
Great
nice to see you. Michael
Thank you.
Purves of BGC Partners.